As the markets closed out the week, BigBear.ai holdings, trading under the ticker BBAI, finished the session at $6.72, marking a significant intraday drop of 5.88%. For a stock that has been a retail favorite in the artificial intelligence space, a nearly 6% slide in a single day immediately raises questions and fuels the narrative of volatility that has become synonymous with the sector. The immediate expectation for many watching this sharp decline is that the high-flying journey of this AI name is hitting severe turbulence, perhaps signaling a fundamental problem that warrants heading for the exits. However, the reality of the situation is far more nuanced and arguably more compelling than a simple daily drop suggests. While the stock price reflects a moment of investor anxiety, beneath the surface, BigBear.ai is sitting on the strongest balance sheet in its history, with a record $391 million in cash. This isn't a company bleeding out, it's a company reloading. This disconnect between the negative intraday performance and the underlying financial fortitude creates a fascinating puzzle. The expectation is weakness, but the reality is a war chest being prepared for a strategic pivot. The common belief surrounding BigBear.ai has been that it's a smaller, more agile version of Palantir Technologies, a company poised to capture lucrative government and commercial contracts in the booming field of data analytics and decision intelligence. With its stock appreciating over 300% in the last year, it's easy to see why this narrative took hold. Investors, including many who frequent platforms like Robinhood and SoFi for their self-investing activities, saw a ground-floor opportunity in a critical tech sector. The chatter was about hypergrowth, about a disruptive force in AI making its mark. But this is where the popular expectation collides with a much harsher reality. When you look past the impressive stock chart and examine the fundamentals, the comparison to a titan like Palantir begins to crumble. The most recent quarterly report was not a story of explosive growth. It was a story of contraction. Revenue didn't just miss expectations, it fell by 18% year-over-year to $32.5 million. The company reported a staggering net loss of $228.6 million, largely due to non-cash impairments, and more worryingly, it had to lower its full-year revenue guidance to a range of $125 million to $140 million. This isn't just a slight miss, it's a significant recalibration that challenges the very core of the hypergrowth narrative that has propelled the stock. The daily trading action reflects this tension. On Friday, over 70 million shares of BBAI changed hands. While this is below its recent 3-month average of around 110 million, it's still an incredibly high volume, indicating a fierce debate between buyers and sellers. The stock traded in a range from a low of $6.56 to a high of $7.19, showing that for every seller spooked by the revenue miss, there was a buyer willing to step in, perhaps focused on the long-term potential. This tug-of-war is happening across various investing sites and within individual brokerage accounts at places like Fidelity and Interactive Brokers. The macroeconomic climate is certainly not helping. Broader market fears stoked by commentary from the Federal Reserve about elevated market valuations have put pressure on growth-oriented tech stocks, especially those that are not yet profitable. When the cost of capital is high, companies burning cash face intense scrutiny. BigBear.ai, with its negative adjusted EBITDA of $8.5 million in the last quarter, falls squarely into this category. Institutional activity provides another layer of complexity. While nearly 80% of the company is held by institutional investors, which typically suggests confidence, there has been significant selling from major stakeholders. BBAI Ultimate Holdings LLC, a 10% owner, has been systematically selling off large blocks of shares over the past year. This kind of consistent insider selling, even if it planned, can weigh heavily on market sentiment, making it harder for the stock to build sustained upward momentum. So, what does BigBear.ai actually do? The company provides artificial intelligence and machine learning solutions primarily for the U.S. government, focusing on national security, supply chain management, and cybersecurity. They build and deploy systems that take vast amounts of complex data and make it usable for decision-makers in high-stakes environments. Their platform is designed to provide decision intelligence, helping organizations anticipate and respond to threats and opportunities. This is a critical field, and the addressable market is enormous. The recent passage of massive government funding bills, including $170 billion for the Department of Homeland Security and $150 billion for the Department of Defense, creates a generational tailwind for companies precisely like BigBear.ai. Its technology portfolio, with offerings like Veriscan for biometric screening and Conductor OS for autonomous systems, aligns directly with these newly funded government priorities. This is the crux of the bull case. The company is positioning itself to capture a slice of a truly massive pie. Recent contract wins, like the one announced on September 23rd to enhance maritime awareness for the U.S. Navy's 4th Fleet during the UNITAS 2025 exercise, prove that they are still very much in the game, securing tangible, important work. Comment below what you think is the single biggest hurdle for smaller defense contractors trying to compete with established giants. However, the path forward is fraught with challenges. The reality of the company's financial performance cannot be ignored. A gross profit margin of around 28% is thin, especially when compared to Palantir's robust 81%. This indicates potential issues with operational efficiency or pricing power. It's one thing to win contracts, but it's another to execute them profitably. The company's management has acknowledged disruptions in Army data programs as a key reason for the revenue shortfall, highlighting the inherent volatility of government contracting cycles. A single delayed or canceled program can have an outsized impact on the financials of a smaller company. Analyst opinions are divided, reflecting the stock's polarizing nature. While the consensus rating might lean towards a moderate buy, the average price target from some analysts sits around $5.75 to $5.83, which suggests a potential downside from the current price. Other forecasts are more optimistic, with high targets reaching $8. This wide dispersion in price targets underscores the uncertainty surrounding the company's ability to execute its turnaround and capture the growth opportunities in front of it. Investors using robo-advisors like Schwab Intelligent Portfolios might see their allocation to such a volatile stock minimized, while active traders on platforms like Robinhood or through interactive brokers might see the volatility as an opportunity. The future outlook for BigBear.ai is a tale of two potential paths. In one scenario, the company effectively leverages its strong cash position to weather the current operational headwinds. It could engage in targeted acquisitions to bolster its technology stack or expand its market reach. If it successfully translates its promising technology into a steady stream of profitable, large-scale government contracts, capitalizing on the new funding environment, the recent stock price dip will look like a historic buying opportunity. The narrative would shift from a struggling growth stock to a successful turnaround story, and the valuation could expand significantly as revenue growth reaccelerates and margins improve. In this reality, the company's strategic pivot pays off, and it solidifies its position as a key partner to the defense and intelligence communities. The expectation of becoming a major player in AI-driven national security will finally be met. The alternative scenario, however, is one where the company fails to overcome its current challenges. The competition in the government contracting space is fierce. Larger, more established players like Palantir may have deeper relationships and more extensive resources, allowing them to capture the lion's share of the new funding. If BigBear.ai's margin issues persist and it continues to struggle with consistent revenue generation, its substantial cash reserves will begin to dwindle. In this reality, the market's patience will wear thin. The current stock price, which still assumes a fair amount of future growth, would come under severe pressure. The expectation would be unmet, and the reality would be that of a company that had the right technology at the right time, but couldn't execute effectively enough to build a sustainable, profitable business. The recent heavy trading volume and price decline indicate that the market is actively wrestling with these two opposing futures. In summary, the story of BigBear.ai is a classic case of high expectations meeting a complicated and challenging reality. The initial excitement, fueled by the broader AI market frenzy and impressive year-over-year stock gains, created a perception of a company on an unstoppable upward trajectory. The actual financial data, however, paints a picture of a business in transition, facing real revenue and profitability hurdles. The intraday drop to $6.72 is a symptom of this conflict. But the analysis cannot end there. The reality is also that BigBear.ai is well-capitalized and strategically positioned to benefit from massive long-term government spending trends. The ultimate outcome will depend entirely on execution. The company must prove it can convert its technological capabilities and market opportunities into consistent, profitable growth. For investors, this isn't a simple story. It's a high-stakes bet on a strategic turnaround in one of the most competitive sectors in the world. The expectation of becoming the next Palantir is for now on hold. The reality is that BigBear.ai must first prove it can be a consistently profitable BigBear.ai.